lecture, we are going to be looking at performance management. Now, it's important for you to understand that companies can either be centralized or decentralized. If a company is centralized, that means decisions are made at a head office level. On the other hand, if a company is decentralized, that means that decisions are made at a divisional level. And when we have large organizations that have expanded rapidly and they have a diversified product range or service offering, it's almost impossible for these companies to be controlled centrally and for decisions to be made at a head office level. Some degree of decentralization is necessary. So in other words, decisions are made at a divisional level. Now, when a company decentralizes and they allow divisional managers to make decisions, they can decide how much responsibility they want to give those divisional managers. So if they classify the division as a cost center, that means that the managers are only accountable for the costs under their control. So they need to make sure that the costs that they incur are in line with the budget and they don't exceed the budget. On the other hand, if the division is classified as a revenue center, then the managers are accountable for the sales revenue that they generate. So in other words, they need to make sure that their sales are as high as possible, and they are not responsible for the cost of the goods or services that they sell. Then, if a division is classified as a profit center, that brings the responsibilities of a cost center and a revenue center together, and managers are now accountable for both costs and revenues that are under their control. Lastly, if a division is classified as an investment center, that means that managers will be accountable for both revenues and costs that are under their control, and they will also have authority to make capital investment decisions. So if a new machine is required in the factory, those managers are allowed to make those decisions. They don't need to go to head office and get authority from head office in order to buy a new machine. So what are the advantages of decentralization, or the advantages of decisions being made at a divisional level? Firstly, it results in more timely decisions being made. You don't need to wait for feedback from head office. The decision is made at a divisional level immediately. And also, it's made by those who are familiar with the situation at hand. And that becomes very important, especially when we have a multinational company and maybe head office is situated in a different country. So if you have head office making decisions for a division that's in a different country, they might not be aware of all of the facts. They might not have detailed knowledge of the laws of that country, of the taxes in that country, etc. So it's much better to have a divisional manager making the decision because they are more familiar with the situation at hand. In addition to that, it allows the manager to exercise greater initiative and it improves motivation. However, there are also disadvantages of decentralization. There is a risk or a danger that managers will make decisions that will increase their own profits at the expense of the profits of other divisions or the company as a whole. So guys, if we have head office making decisions for the company, they are always going to make decisions that are in the best interest of the company as a whole. However, if decisions are made at a divisional level, there's a risk that this manager over here in Division A will make decisions that benefit his division but are not necessarily beneficial to the company as a whole or beneficial to Divisions B and Division C. So that's obviously a risk or a danger of decentralization. Now, please note the correct terminology to be used over here. If we make decisions that are in the best interest of a company as a whole, that means that the decision is goal congruent. So if we have divisional managers that are not making decisions that are in the best interest of the company as a whole, that means there is a lack of goal congruence. Now, if divisional managers are given authority to make decisions, they must be held accountable for the decisions that they make. So in this lecture, we are going to be looking at 3 different measures that can be used for the purposes of evaluating managerial performance. First, we are going to look at the calculation of return on investment. We will then look at residual income. And lastly, we will look at economic value added, or EVA. Now, please note, when performing all of these calculations, it's very important that we only take into account costs that are directly controllable by the manager. If we are trying to evaluate the performance of a manager, it is not fair to include costs in the calculation that are not under their control. So when we perform all of these calculations, we only include costs that are under the control of the manager in our calculation. We are going to start with the calculation of return on investment. And we calculate return on investment by taking our controllable profit, so profit that is under the control of the divisional manager, and this must be before interest and tax. And we then divide by our controllable investment. And please note, this is going to give you an answer as a percentage. Now, just below, you can see how we perform the calculation for controllable investment. We take our non-current assets and we add our net working capital. And please note that your net working capital is just your current assets minus your current liabilities. Now, long-term loans are normally arranged at a head office level, and they are therefore not under the manager's control. So that's why when we are performing this calculation, our controllable profit is before interest, because any interest or finance costs on long-term loans are not under the divisional manager's control if the long-term loan was entered into by head office. So we use controllable profit before interest. And in addition to that, when we are calculating our controllable investment, we do not include non-current liabilities. We only take into account our non-current assets, our current assets, and our current liabilities. All right, and that's obviously if you are not told otherwise. If you are specifically told that the divisional manager has authority to enter into loan agreements, then you would take the finance costs and the non-current liabilities into account in your calculation. However, if the question is silent, please note that we assume long-term loans are entered into at a head office level. We ignore the non-current liability and the associated finance costs. Let's have a look at an example just below. Below are the financial results of Division Seattle and Division Costa for the year ended 31 December 20X2. We've got gross profit, then we have an allocated admin overhead. Now please note, if this is an allocated cost, it means it's a cost that is incurred at a head office level and it's been allocated to the divisions. So this cost is definitely not under the control of the divisional manager. We then have selling and distribution costs, net profit before interest and tax, finance charges, and tax. Then in the other information, we have non-current assets, current assets, long-term liabilities, current liabilities, and the cost of capital. So please remember, I said to you, unless you are specifically told otherwise, long-term liabilities or loans are negotiated at a head office level and are not under the control of the divisional manager. So we will not include long-term liabilities in the calculation of return on investment. Further to that, please note that the cost of capital represents the minimum return that is required. So both divisions require a minimum return of 15%. Let's calculate the return on investment. We start with our controllable profit before interest and tax. So please note, we don't take our interest or our finance costs into account. We do not take tax into account. we start with our profit before interest and tax. Then it must be the controllable profit before interest and tax. So if there are any costs that are not under the control of the divisional managers, so these allocated admin costs, we need to eliminate those costs. So we are going to add back these costs that are not under the divisional manager's control. So you can see it's a very simple calculation. There's my calculation for Division Seattle and my calculation for Division Costa. Then we need to divide by our controllable investment. And your controllable investment is just your non-current assets plus your current assets minus your current liabilities. So all of the required information was provided above. Here's my non-current assets, my current assets, and my current liabilities. This is a very, very simple calculation. All right, so for Division Seattle, we calculate a return on investment of 23%, and for Division Costa, we have a return on investment of 36%. So both of them are exceeding the minimum return required of 15%. So both divisions have performed well because their return on investment exceeds the cost of capital. However, if we are trying to compare the performance of the two divisions, it's important to note that Division Seattle has a higher controllable profit than Division Costa. However, Division Costa has a higher return on investment. And the reason for that is because they have a lower asset base, and Division Seattle has a higher asset base. So because Division Seattle has a higher asset base, even though their profit is higher, they have a lower return on investment. On the other hand, with Division Costa, they have a lower profit. However, because their asset base is lower, they have a higher return on investment. So you can see that discussion just below. Based on the above, we can conclude that both divisions have performed well because both are generating a return in excess of their cost of capital. We can further conclude that even though Division Costa has a smaller profit than Division Seattle, they have a superior return because of their lower asset base. Now I want you to assume that Division Seattle is considering the following new investment. The investment has a cost of 1.2 million rand, and the controllable profit before interest and tax is expected to be 240,000 rand. So if we calculate the return on investment, we take our controllable profit before interest and tax, and we divide by our controllable investment. So this new investment is expected to have a return of 20%. Now I want you to assume that you are the manager of Division Seattle. If you are the manager of Division Seattle, we calculated that this division currently has a return of 23%. The new investment is expected to have a return of 20%. So would you accept this new investment? No, because the investment has a lower return than your current return. So it's going to cause the return on investment for Division Seattle to decrease. So managers will be reluctant to accept this investment. However, that is the incorrect decision. That is not goal congruent. You are not making the decision in the best interest of the company as a whole. What is the reason for that? This division has a cost of capital or a minimum return that they require of 15%. This investment is expected to have a return higher than the cost of capital, so it should be accepted. But the manager might make the incorrect decision and reject it because it is lower than their existing return on investment. So you can see that discussion just below. The manager of Division Seattle would reject this investment because the return on investment is less than their existing return of 23%. However, the investment return exceeds the cost of capital, and it should therefore be accepted. This example illustrates how return on investment can lead to a lack of goal congruence. Or in other words, this shows us a disadvantage of return on investment. One of the disadvantages of using return on investment to evaluate performance is managers are not necessarily encouraged to make the decision in the best interest of the company as a whole. This investment should be accepted because it has a return in excess of the cost of capital, meaning the value of the company will increase if it is accepted. So it should be accepted. However, because the return is lower than the existing return, managers will not want to accept this investment. So if you just look below, you can see we have all of the disadvantages of return on investment. I want to cover the one disadvantage with you now because it links to this example. Projects or investments which earn a return higher than the cost of capital will generate shareholder wealth or increase the value of the company and should therefore be accepted. However, managers will be reluctant to invest in projects which might benefit the company as a whole if the return is lower than the existing return. So there's a risk that they don't make decisions that are in the best interest of the company as a whole. There's a risk that there is a lack of goal congruence. We are now going to go through all of the advantages of return on investment, and then we'll look at the remaining disadvantages. So the first advantage is it's easy to calculate and understand. You saw above when we performed the calculation. It's a very simple calculation to perform. It's also very easy to understand. In addition to that, we know that return on investment is expressed as a percentage. So that means returns of other divisions or outside competitors can be compared. We know that the division with the higher return on investment has performed better. And in addition to that, the income is compared to the size of the investments. So if you go back to our calculation, if we just look at controllable profit, then it looks like Division Seattle has performed better than Division Costa because they had a higher controllable profit. However, when we compare it to the size of the investment, we can see that Division Costa has outperformed Division Seattle. They have a higher return on investment. So this means that Division Costa is using the available assets more effectively in order to generate a return. So that deals with the last advantage. The income is compared to the size of the investment. However, there is also a potential disadvantage over here. This low asset base that we have could indicate that Division Costa's assets are old, reaching the end of their useful life, and actually require replacement. However, the manager doesn't want to replace the assets because if they replace the asset, this investment base is going to increase. And if the investment base increases, the return on investment will decrease. Or alternatively, if we look at this from the perspective of Division Seattle, maybe this divisional manager has recently purchased new assets or replaced assets, and that's why the investment base is higher. And if the investment base is higher, if they have newer assets, that is going to cause their return on investment to be lower. So if we look at the first disadvantage that we have over here, managers may be reluctant to invest in new assets because if the investment base decreases, then return on investment will increase. So that's one way that they can actually manipulate this calculation. Another disadvantage is the short term is emphasized and managers are discouraged to make investments or incur costs which might benefit the company over the longer term, but they have a negative impact on return on investment figures over the short term. So what am I talking about over here? If these divisions incur costs such as training their employees, they incur expenditure on advertising, they are innovative, and they incur costs on research and development, all of these costs will have a negative impact on their profit in the short term. So it will cause their controllable profit to decrease, which will cause return on investment to decrease. So managers won't want to incur all of these costs. However, that's a very short-term focus because these costs are necessary for the long-term success of the company. If the company wants to be successful and competitive in the long term, they need to train their employees, they need to advertise, they need to invest in research and development. So another disadvantage of return on investment is managers focus on the short term, they focus on maximizing short-term profits, and they don't want to incur costs that could actually benefit the company in the long term. Then lastly, comparison between divisions with different investment or asset bases is difficult. Now, I already said to you above, one of the advantages of return on investment is our answer is expressed as a percentage, which means we can make comparisons. However, if the divisions have different investment or asset bases, so in other words, if the one division rents their assets and the other one owns their assets, if the one division has old assets and the other one has new assets, if the one division is labor intensive and the other division is capital intensive, then these differences can make comparison difficult. Let's go back to our calculations above. We know that Seattle has a higher asset base and Costa has a lower asset base. And as a result of this, Costa had a higher return on investment. Now, what could have happened? Perhaps Costa hasn't actually outperformed Seattle. Perhaps what's happening is Seattle owns their assets. So if they own their assets, they have a higher asset base. And Costa rents their assets, they therefore have a lower asset base. So if that's happening, then Costa hasn't actually outperformed Seattle. It's just because there's differences in the investment or the asset base. In addition to that, what could happen is Costa might have old assets that are reaching the end of their useful life that have been depreciated, so they have a lower asset base, and Seattle might have recently purchased new assets, and therefore they have a higher asset base. And because of that, it looks like Costa has outperformed Seattle. Or what might be happening is Costa might be labor intensive, so they don't have a lot of assets. On the other hand, Seattle might be highly automated and capital intensive, so they do have a lot of assets. Now, we don't know for a fact that these are actual differences, but if there are differences like this, you guys can see comparison then becomes difficult. And we can't just say that Costa has outperformed Seattle just because of the fact that they have a lower asset base. So that deals with return on investment. We are now going to move on to the calculation of residual income. And residual income overcomes some of the disadvantages of return on investment. So this is the formula that we use to calculate residual income. We are still working with exactly the same inputs. We still use controllable profit before interest and tax and our controllable investment. However, instead of dividing by the controllable investment, we now deduct the controllable investment multiplied by the cost of capital. So if you look at the example just below, we are still using the same information that was used in our return on investment example, and we are going to calculate residual income for both divisions. So we take our controllable profit before interest and tax, and we deduct the controllable investment multiplied by the cost of capital. And please note, instead of getting an answer as a percentage, we now have an answer as a rand amount. So this is an absolute rand amount. Now you'll remember I told you the cost of capital is the minimum return that is required. So we are comparing their actual profit or the actual return to the minimum return that they require based on the assets that that division holds. So if we have a positive residual income, that means the actual return is greater than the minimum return. So you can see the discussion just below. Based on the above, we can conclude that both divisions have performed well because both of them have positive residual incomes. On the other hand, if we calculate a negative residual income, that means the actual return is less than the minimum return, and then the divisions have not performed well. In addition to that, we can also see that Division Costa has a higher residual income than Division Seattle. So we can further conclude that Division Costa has contributed more to the total group profit than Division Seattle. Then once again, I want you to assume that Division Seattle is considering the following new investment. The investment has a cost of 1.2 million rand. The controllable profit before interest and tax is expected to be 240,000 rand, and they've calculated the residual income to be positive 60,000 rand. So this calculation has been performed as follows. We take the controllable profit before interest and tax. We deduct the controllable investment multiplied by the cost of capital. So this new investment has a positive residual income of 60,000 rand. So the manager of Division Seattle would accept this investment because the residual income of the division will increase by 60,000 rand. So Division Seattle currently has a residual income of 537,500. So by accepting this investment, it will increase by 60,000 rand to 597,500. So residual income therefore overcomes one of the disadvantages of return on investment. You'll remember we said one of the disadvantages of return on investment is if the new investment has a return that is lower than their current return, then the manager will reject the investment even though the return exceeds the minimum return. So they might not make the right decision. They might not make the decision that is in the best interest of the company as a whole. Or in other words, it is not goal congruent. So we saw that over here. So residual income overcomes that disadvantage because now the residual income of the division will increase as a result of the new investment. So the divisional manager will accept the investment and they are then acting in the best interest of the company as a whole. Or in other words, the decision that they make is goal congruent. So when using residual income, there is a greater chance that managers will be encouraged when acting in their own best interests to also act in the best interests of the company. So if you look at the advantages of residual income on the next page, you'll see the first advantage deals with this. Suboptimal decisions are discouraged as residual income encourages managers to accept all investments which yield a return higher than the cost of capital. Then another advantage of residual income is the division's contribution to the group's profit is clearly measured. So we can see exactly what each division is contributing to the total company profit. So we can see Costa is making a larger contribution to the total group profit. Another advantage of residual income is it is more flexible and we can use different cost of capital percentages where we have divisions with different risk profiles. So in my example, we used a cost of capital percentage of 15% for both divisions. However, if the divisions have different risk profiles, we can use different cost of capital percentages in order to take that into account in our calculation. However, there is also a disadvantage linked to that. If we do use different cost of capital percentages, managers may become disgruntled. So for example, if we use 10% for the one division and 15% for the other division, the managers might say that it's unfair and they become disgruntled. Let's look at the remaining disadvantages for residual income. We saw when we performed the calculation that it is an absolute measure. We get our answer as a total rand value, and that makes comparison difficult. One of the advantages of return on investment is it gave us an answer as a percentage, which facilitated comparison. So now we are dealing with total rand amounts, which makes comparison difficult because larger divisions should have a larger residual income. Another disadvantage is residual income is normally not as easy to understand as return on investment. And the last disadvantage over here is exactly the same as the disadvantage that we looked at with return on investment. The short term is emphasized. So managers might not want to incur costs or make investments that could be beneficial to the company over the long term, but will have a negative impact on short-term results. So in other words, they won't want to spend money on training employees, on advertising, on innovation, research and development, because all of that has a negative impact on their controllable profit in the short term. So obviously, if your controllable profit over here decreases, your residual income will decrease, so they won't want to incur those costs. However, they should be incurring those costs because they are to the benefit of the company in the long term. So that disadvantage is exactly the same as the disadvantage that we looked at with return on investment.